Okay, I think we're live. Good afternoon, everybody. Thank you for joining this Invest Engine webinar in partnership with WisdomTree on quality, the all-weather investment. I'm Andrew Prosser. I'm the head of investments at Invest Engine, and I'm joined today by Pierre Debru, the head of quantitative research and multi-asset solutions from WisdomTree. Now, in terms of the plan for the webinar, I'm going to hand over to Pierre in a second, and he's going to go through a presentation on why you should consider investing in high quality stocks. That's going to last about 20-25 minutes. Then I'm going to give a very brief demo of how to buy the ETFs, which Pierre's research and presentation is based on, using the Invest Engine platform. And then we'll leave about 10 to 15 minutes at the end for Q&A. Now, this is new webinar software for us, so please bear with us. But if you do want to ask questions as Pierre's going through the presentation, you should be able to click on the private chat button in the top right of your screen, and we'll answer as many questions as possible at the end. So all that leaves me to say before we jump into it is the usual disclaimer that your capital is at risk whenever you invest, and that none of this is financial advice. So with that, I'm going to hand over to you, Pierre. Take it away.
Thanks, Andrew. And so before we jump really into the more technical part of why to invest in high quality companies, I wanted to start with a very quick outlook on equities and what we've seen in equity markets this year and what we could see next year. And so if we go to the next slide, we can have a quick look at what the IMF is seeing in terms of growth globally. And what we are seeing is relatively sluggish growth for 2023 and also for 2024. So even if the market and the economy have been quite resilient this year in the face of extremely sharp rate increase across the world, right? We started 2023 with relatively pessimistic views on the economy due to the very sharp increase of interest rate. Economies have been quite resilient, especially the US, but still the outlook for 2023-2024 here from the IMF is relatively slow growth, which is going to potentially weigh potentially on equity markets. So that's something to keep in mind for the next 12 to 18 months in equity market. In the next slide, we can look back a little bit at the equity markets for this year, and what we can observe first is that the first half of 2023 was almost a mirror image of the first half of 2022. 2022 was a very value-driven year, right? In the sense of cheap companies that are cheap, companies that are paying a lot of dividend perform extremely strongly, while tech stock or growth-oriented stock perform a lot less well because of this increase in rate that were extremely fast, and that obviously created a lot of headwind for companies in tech or growth companies that are relying a lot on borrowing money. What we've seen in the first half of 2023 is the reverse image of that, where all growth stocks, tech stocks have done extremely well, and value stocks, so the cheap stocks and the dividend or the income stocks have done a lot less well. So that's something to keep in mind. The other thing to keep in mind for 2023 in terms of what we've seen in the market is that we've seen a bull market across developed market and in particular in the US. But in fact, if you look a little bit deeper in that bull market, it was a bull market which was extremely narrow in the sense that it was driven by a very small number of stocks. We could say it's the Magnificent Seven. It is basically the US tech stocks that have performed extremely strongly. So the Apple, the Amazon have pulled the market forward. But if we look beyond those stocks, performance was not that great in 2023. So there was a lot of dispersion in the market. What does that mean if we look forward and if we take into account the fact that rates are meant to stay higher for longer, and the fact that growth is meant to be a little bit lower or at least to slow in the next 18 months, it means that we would expect potentially those Magnificent Seven to slow down, and we would see performance in equities to be quite dispersed again, but across the full universe. Now, if we move one slide forward again, this is the performance of different type of stocks. So here I call them factors, but basically you can see in dark blue income-oriented stocks, so dividend. In light blue, the stocks that are growing really fast, so I call that growth. Value stocks in purple, so cheap stocks. In gray, you have quality stocks, so high quality stocks, so companies that are doing well, that are very robust, that are very profitable. In orange, it's mean volatility, so it's stocks that are not very volatile, so are quite risk adverse in some way. And size, which means basically small cap, which means small company, right? Companies that are smaller than the rest. And what we see here is the different performance of those different type of companies over different periods. And like I was saying before, in 2022, the best performer were value in purple and dividend in dark blue. But if we look year to date, that has shifted a lot. And the best performer are now growth and quality. That's quite interesting because that potentially gives us some indication of what to look at for the next 6 to 12 months. In the face of what I was saying, which is potentially lower growth, rates that remain higher for longer, and an extension of the bull market that was extremely narrow and potentially this breadth going up. So if we move to the next part of the presentation, which is focused more on high quality stocks, why do we want to talk about high quality stocks right now? Is because we're thinking that there is going to be a lot of uncertainty in the equity market. We are thinking that the volatility in equity market is going to get higher, and therefore there is going to be a difficult choice in some way for equity investors in terms of where they want to invest their money. At WisdomTree, we think that high quality stocks are quite an interesting part of the market in this type of period where there is a lot of uncertainty, where the volatility is higher. If we look at the next slide, we'll see 4 reasons why we think that. The first reason is that if you look at both academic work, so financial academic work, and if you look at active managers, there is a kind of consensus around high quality companies. If you look at active managers, being value managers, being growth managers, at the end of the day, in their investment process, there is always a quality filter in the investment process. They always tend to favor high quality company in their process. If you look at academics, you'll see that there is a lot of research that has been done around which part of the market tends to outperform. And academics have shown in particular that high quality company over the long term, they tend to outperform the market. They tend to do better than the market. So high quality company can be a source of outperformance. Quality company can also be quite defensive. They can protect in equity drawdown. Why? Because there is a type of behavioral thing that happen in the market is that if the market is more volatile, if investors are a little bit more nervous about the trajectory of equities, they tend to come out of the riskiest equity and move their money to companies that are more stable, that are stronger, and that's the high quality company. So in periods of unrest, if you want, in equity markets, you have a tailwind toward quality companies that is the result of this behavior from investor. And so that creates defensiveness for high quality company. And so they tend to show a smaller drawdown than the rest of the market. The last thing that you can see on this slide is what we call all-weather behavior. But basically what that means is that if you look at the behavior of quality companies across the business cycle, you realize that they tend to do quite well at different parts of the business cycle. And so from a strategic investment point of view, or for a long-term strategic investment, it's quite interesting to have a type of stocks that do well at different parts of the business cycle, because it protects the investor from potential deep drawdown. So if you go to the next slide, we'll show just here this slide shows the work from academics. In this case, it is Professor Kenneth French, who is a very renowned professor in the work of factors. And you can see here the way it looks at quality companies. So you can see in gray the developed market equities, right? So let's say MSCI World. You can see in light blue a portfolio that is rebalanced every year to focus on the low quality companies in the market. And in dark blue, a portfolio which is rebalanced every year to show the high quality companies in the market. And what we observe is that over a long period of time, here we're showing 33 years, you see that the high quality baskets has outperformed the market, and also that the high quality basket has less volatility than the market, right? So you can see straight away what I meant when I say you have this long-term historical outperformance of high quality companies. This is what I meant. If you do the work over a long period of time, you see that high quality companies, they tend to outperform the market. In fact, if you do this graph or if you do this work on US equities, if you do it on European equities, if you do it on emerging market equities, you'll find the same type of results. High quality companies tend to outperform the market with reduced volatility. Moving on to the next slide, we can try to look at what we mean when we say all weather, right? So here, what we are looking at is the behavior of equities, in this case, US equities, across the business cycle. So we split the business cycle into 4 phases: early recession, late recession, early expansion, late expansion. And then we calculate on average the outperformance or the underperformance of high quality companies versus the market, right? And what we observe is that in each 4 parts of the business cycle, high quality companies have historically outperformed, right? So that's quite interesting because it means that if you are in early recession, or if we are in late recession, or if we are in early expansion, in all 4 parts of the business cycle, high quality companies are able to create some outperformance for investors. So that's really what it means to be all weather. It means that you are able to create some outperformance in many parts of the business cycle, and that's obviously quite interesting for long-term investment. Another way to show this is what we show on the next slide, and maybe to, sorry, can we go to the next slide? And to compare that to other type of equities, right? So I was talking about small caps, so smaller companies. I was talking about cheap companies with value. I was talking about lower risk company with low volatility. In this graph, we are looking at very long history, so starting in the 1960s, and we are looking at the performance of those different type of companies versus the market over rolling 10 years period, right? So we are looking at 10 years period over time, and we are looking at how many times does high quality company outperform versus the market compared to how many times they underperform, right? And what we see is that small cap companies, they outperform the market in 59% of those 10-year rolling period. Cheap companies, they outperform in 75% of those 10-year rolling period. But then you have quality, so high quality companies, they outperform in 90% of those 10-year rolling period. So if you look at the graph, the dark line, which is quality, you see that it is very stable. It is mostly above 0. So you have 90% of the time this outperformance. If we compare that, for example, to the blue line, which are small caps, which are smaller companies, we see that the blue line is sometimes above 0, sometimes below 0. So you have less consistency. It's only 60% of the time that small cap companies outperform the market. But also you see that you have some period of strong outperformance, more than 10%, and you have some performance and some periods of strong underperformance with -6, -7, -8%, right? The dark blue line doesn't show this at all. It shows something which is a lot more consistent, and that's why we think that quality companies have this really resilient all-weather behavior that is interesting for long-term investment. Another thing to look at, knowing that we are now coming up to the end of this rate hike cycle, right, is on the next slide, where we looked at the performance of high quality companies in the 12 months that follow the end of a rate hike cycle. And what we see here is that in the last 7 rate hike cycle, in the 12 months that follow the end of that hike cycle, quality has outperformed the market, right? So we see a consistent pattern of high quality companies doing well in the 12 months that follows the last rate hike. And we are probably in those 12 months, the Fed has not raised rate for a few months now. So we probably have seen the end of the rate hike cycle. And so we are probably in those 12 months where historically high quality has done well versus the market. A last point that's also interesting if we think about investing in equity for the long term is on the next slide, is another way to look at equity markets, and the idea is to split the equity markets between dividend payers and non-dividend payers, right? And what we see on this graph here is that on average, over the very long term, dividend payers have performed significantly better than non-dividend payers. You see that dividend payers have returned 9.18% per annum since the 1960s, when non-dividend payers have returned 3.95. What's even more interesting maybe is that inside the dividend payers, you see that the dividend growers, i.e. the company that are paying dividend but also growing their dividend from one year to the next, have performed even better, outperforming those dividend payers. So from the point of view of WisdomTree, when it comes to think about building a strategy that would be strategic investment in equities with this kind of all-weather behavior and looking for potential outperformance over the long term, we do think that mixing high quality companies and dividend growing companies is an interesting way to go. And that's why if we go to the next part of the presentation, and in particular the next slide again, we can show a strategy that try to combine those high quality companies with those dividend growing company in an index that we've called WisdomTree Global Quality Dividend Growth Index. And you can see historically the performance of this index versus the market. You can see that the WisdomTree Global Quality Dividend Growth Index has outperformed the MSCI World Index over the last 7 years by 1% per year, right? So the annualized return of the MSCI World is 8.7% for those 7 years, when the annualized return for the WisdomTree Global Quality Dividend Growth Index is 9.7%, so 1% better per annum. But also the volatility is reduced, going from 15.8% for the MSCI World to 14.6% for the WisdomTree Quality Dividend Growth Index. So we show here the advantage of focusing inside the equity market on the high quality dividend growing stocks, because we can observe that historically that can create some outperformance, and that can also create some reduction of the volatility. Now, in the next slide, we can dig a little bit deeper inside that index. So that index includes around 600 stock, again selected based on high profitability, high quality, and also capacity to grow the dividend in the future. So you have 594 stocks right now in that index, and you can see on the right hand side the top 10 holdings of that index, where obviously you're going to see Microsoft and Apple, they're still in there, but you also can recognize that this top 10 is quite different from the top 10 in the MSCI World. It doesn't include non-dividend payers. We've seen that the non-dividend payers historically have done less well than dividend payers or dividend growers. So that's why in that top 10, you're not going to find Amazon, you're not going to find Meta, you're not going to find Netflix, because they don't pay dividend. And so they've been screened out. But you're going to find maybe more famous company for dividend payment, right? So you're going to find some healthcare company like Roche, or like Johnson & Johnson, or like Novartis. You're going to find some consumer staples company like Nestle and Coca-Cola and Procter & Gamble. So clearly we see this dividend payer, dividend grower, high quality angle in that top 10, which differentiated a lot compared to an MSCI World index. If we move to the next slide, we can also look at the fundamentals of that index. So you can see in dark blue on the left-hand side, the return on equity and the return on asset of the index. So clearly the return on equity is a lot more elevated for that index than for the MSCI World Index, with 26.3 compared to 15. So a clear focus on those high return on equity companies. Return on asset is also very elevated, 5.5 versus 2.6. So again, a strong focus on this highly profitable company. Now, if we look on the right-hand side, we can see that the dividend yield is 2.5% versus 2.1% for the MSCI World. So we really see this focus on the dividend payers, where the dividend yield is higher than the market. But also, if you combine the idea of having a higher dividend yield, but also very profitable company, highly profitable company, you can relatively easily imagine that those type of company will probably be able to grow their dividend in the future because they generate enough cash that they will be able to distribute it to their shareholder. So it's really this combination of dividend payment and high quality, high profitability that this portfolio is looking for. In the middle, you can see price to earning ratio. You can see that the WisdomTree Global Quality Dividend Growth Index is a little bit more expensive than the market, but less by basically 0.8, so relatively close, even if a little bit more expensive. But that's, I think, quite a nice result already, because you're looking at a portfolio which is very high quality. We've seen the return on equity, we've seen the return on assets, and yet the valuation is basically on par with the index, which means that you're not paying a lot more for the high quality of the portfolio in that index, right? And that's kind of the advantage of mixing high quality with dividend growing companies, and the advantage of basically excluding non-dividend payers. It allows the valuation of the index to remain quite close to the valuation of the market, while tilting the index very much towards high quality companies. So that's really, I think, what we wanted to cover today. Very much looking at where we are in the equity market right now, with a potential for volatility and uncertainty in the market going forward, and therefore we wanted to really show this potential interest in high quality companies mixed with dividend growing companies to weather the potential choppy market that we're going to have in the next 12 to 18 months.
You hear me? There we go. Hi, I'm back. Thank you very much, Pierre. Now, I'm sure everybody on the webinar will be thinking that this all sounds great. The research is certainly very compelling, but how do I actually invest in this? So I'm just going to take a couple of minutes, it's very brief, and do a quick walkthrough of add securities in there. Oh, is the video still playing? Sorry, slight technical glitch. It looked like it was working okay there. I can just hear Elspeth having a heart attack in the background. Right. Let me see if I can take control and try playing it. Bear with me. And it's just crashed again. That's a shame. I think there's a problem with the video. Okay, well, I'll talk through it anyway. Once you, as you can see there, you click Add Securities in your portfolio, and you go through it. It has a list of all of the WisdomTree ETFs on there. We've got, we might have a technical solution. Can we skip forward a couple of seconds? Let's just play it from the beginning in case it messes up again. Yeah, so this is our home screen, going to DIY portfolio, third time's the charm. And then we're going to add securities. And here we go, new territory now. We click the WisdomTree banner at the top, which brings up all the WisdomTree ETFs. And you can see once they load, there's loads on the platform there. We've got artificial intelligence, we've got cloud computing, we've got all sorts. It goes down to equity income, you can see there. But what we've been talking about today is the quality dividend growth ETFs. So we can search for quality dividend in the top here. And that brings up all the different flavors of the quality dividend ETFs that we've got on the platform. So we've got the global one at the top. There's also the Eurozone one and the US one down the bottom. We've got both the hedged and the unhedged share classes, and both distributing and accumulation. So once you pick the ETF you want, I went for the global one there, you add to portfolio. And then on the next screen, you can see it's in there. It's in the portfolio now in the top right there. And then we can continue and adjust the target weights of the WisdomTree ETF to whatever you want. I'm just going to take 10% out of this equity ETF there and put 10% into WisdomTree. Then continue. And on the next screen, you can see how the portfolio looks with this change we've just made. So we're slightly increasing North America there. And on the sectors, we're slightly increasing industrial. And then in terms of the next tab on the individual holdings, slightly reducing Apple. And then we can save and continue if we're happy with that. And now we are done. All we have to do is fund the account, or if it's already funded, then we just rebalance to our new target weight. And it is as easy as that. So that kind of gives you a brief overview of how to access the WisdomTree ETFs on the Invest Engine platform. And it is now time to have a look at the Q&A. So if you do have any questions, we've kind of got 10-15 minutes allocated to answer questions. So if you do have any, just type them in the private chat box on the top right of your screen there. And we've got a couple coming in here. So I will start with this one here, the top one. We've seen that quality stocks tend to outperform, and even more so when you include the dividend growth filter, which you just showed in your presentation. But what is it about quality stocks that makes them outperform? What gives them this special attribute?
Yeah, so that's a question that in some way academics have been working on for a very long time. The idea, the main idea is that it's basically, it seems to be a behavioral reason, which is that investors tend to underestimate the quality of companies initially. And so kind of so that means you can buy quality companies relatively cheap compared to how much they should be worth, and that basically creates a premium over the long term. So that's kind of the academic reason for it. But what's also interesting on top of the premium for quality, as I was discussing, is also the behavior, right? And so the behavior is also very interesting because of this kind of all-weather behavior.
Yeah, that makes sense. I love these randomly generated names that the webinar software gives to people. So we've got a question from Violet Endeavor, who is quite new to this and asking how you know when a company is a high quality company. I guess what criteria do you use to filter the stocks?
Yeah, so exactly. So we use basically, I mean, just to simplify a little bit, but we use three main things. We use return on equity. So we want company with high return on equity. We use return on assets. We want company with high return on assets. And we want company that have high estimated earning growth. So the capacity to grow, or the estimation that they will be able to grow their earnings going forward. Why do we want these three things? Is because when we talk about high quality company, the way we understand this at WisdomTree is highly profitable company. So companies that are able to generate a lot of cash. And so return on equity, return on assets are two nice metrics to really assess how profitable a company is. And earning growth is really important if we want companies that are going to be able to grow their dividend in the future, because if the company is able to grow its earnings and if the company is very profitable, that will translate into a significant amount of cash that can be then deployed into dividends.
Yeah, that makes sense. And there's a question here about the kind of back testing from Black Apollo, a question about the back testing period. So we've got, I think he says the performance in the presentations over the last 7 days. I think he means years. Is that when the strategy launched or the index launched, or do you have performance back tested over a longer period?
Yeah, so the 7 years is the live performance of the index. So we always like to show live performance, right? So, but in fact, we also have a US equity index, which itself has 10 years live performance. So that's something also you could have a look at. We also have done a lot of research, and so we have a lot of backtests that go a lot further back, but we tend not to show backtests for obvious reason. But so here we are showing the live performance of the index, which is 7 years, and the US we have 10 years, but the results are very similar.
Yeah, I think something that's important to understand is that we've seen the presentation looks great, really great performance over the long run. But in what scenarios, in what situations is this sort of strategy likely to underperform the broader market?
Yeah, I think that in the slides I showed a little bit this when I was showing the 4 period of the business cycle. And even if high quality companies they do well across the 4, there was one type of period where it was doing less well than the other 3, and that was what I called early expansion. But what that means basically, it means rebounds, right? If you're thinking about an equity market which is first dropping, you have like bad economy, equity market are going down 10, 15, 20%, right? High quality companies, they tend to be defensive, so they tend to do better. So you're going to have this cushioning effect. What we see as well is that therefore the low quality company, the cheap company, they tend to do worse than the market, right? They tend to suffer more because investors come out of those companies to go into the high quality one. But what that means is that once the scare is over, when the economy starts to pick up again, and so you start to be in this early expansion part, then those companies that have suffered a lot, they rebound extremely strongly. When high quality company, because they haven't not suffered that much, they don't rebound as strongly, right? And so in that period of the business cycle, then high quality company, they usually don't rebound as fast as other type of company. And so you would argue that that's probably the type of market where those type of companies struggle the most.
Yeah, that makes sense. And just on staying on the risk side of things here, we've got a couple of questions that are related. We've got one from Red Mercury and one from somebody else. One question is, would you replace bonds with the quality ETF given it's an all-weather edition? And kind of related to that, is this kind of strategy meant as a core holding in a portfolio, or is it more of a kind of satellite position?
Yeah, so starting with the second question, we consider it to be more of a core exposure because you can hold on to it over the business cycle. So it can be a strategic holding for the portfolio. Now, in said that, it remains an equity exposure, and there is a lot of value to play on the diversification between asset class, right? To have some equities, to have some bonds, maybe to have some other asset class as well around. And so I would argue that no, quality ETF is not a replacement for bonds per se. There is a lot of value to have both equity and bonds in the portfolio, but it can be a core strategic holdings in the equity sleeve.
Yeah, no, that makes sense. A question here on ESG, that stands for environmental, social governance. Are there any kind of ESG filters or criteria applied to the stocks during the selection process?
Yeah, so the index includes some ESG exclusion filters. They're based around activity, so things like controversial weapon, thermal coal, tobacco, unconventional oil and gas. This type of companies would be filtered out during the process of the construction of the portfolio in the index.
Yeah, that makes sense. So next question, it's kind of a combination of two. We've got a couple of similar group questions here. Firstly, why do high quality companies pay dividends? Surely they can use it for their own growth. There's one question from Green Atlantis there. And secondly, we can see you mentioned there that you applied a dividend screen to the quality stocks there. But second question is kind of how is that dividend filter applied? Is it based just on dividend yield or historic dividend yield forward looking? How does that screen work?
Yeah. So starting with the first one, why do quality company pay dividend? That's a good question. Some of them don't. So that's why I was talking about Amazon, for example, Netflix. It's hard to argue they are not profitable, right? They're obviously extremely profitable company, but they don't pay dividend. So why do high quality companies tend to pay dividend? Usually it's because they generate so much cash that they don't even know how to use it properly in their business model, right? There is only so much you can do in terms of investment and developing the company and so on. So that's probably one of the main reasons why they would pay dividend. The second reason to pay dividend is just a relationship with your shareholders, right? Shareholder expect dividend. And so if you want to have a strong relationship with your shareholder, if you want to be a stock that is liked by shareholders, paying dividend is a nice way to do this. And if you can do it, then probably you should. So that's probably the reason for that. The question about the dividend selection in the process. So I guess you could argue there's two ways. First, we screen the index screen out non-dividend payers. So that's one way to go. So all the non-dividend payers they're excluded. Now we want to be very clear. The focus of the index is quality first, right? So the first thing we do is we select high quality companies by the ROE, by the ROA, and so on. And then we want to give a bonus to dividend payers. And so when we weight companies, we weight by how much dividend they pay. But we don't weight by dividend yield for a reason which is very simple, which is that dividend yield doesn't take into account the size of the company, right? A very small company can have a huge dividend yield. And so if you weight by dividend yield, you create a small cap bias. So you create a bias towards smaller companies. And as we've seen in the slides, small cap is extremely cyclical. It is a factor that is extremely volatile. And that would kind of counteract the all-weatherness we want from the portfolio, which is why we give a bonus to higher dividend companies in terms of weight, but based on the total amount of dividend in dollars that they pay, not based on their dividend yield.
Yeah, no, that makes sense. And I think this question is actually kind of related to your answer there. So it fits in quite nicely. Obviously, with these sorts of screens, it'll skew quite heavily towards different regions and different sectors, different types of companies. So how do you avoid being overly concentrated in any one region or sector or stock? Do you have kind of limits in place in the portfolio?
So yeah, the short answer is we do have limits. We have country limits, sector limits, individual stock limits to make sure that the portfolio is diversified. It doesn't mean that we force ourselves to have exactly the same sector weight as the benchmark, for example, right? The WisdomTree Global Quality Dividend Growth Index is going to be overweight or underweight some sectors at a given point in time. But we have limits to make sure it's not 50% in healthcare, for example. Having said that, what's interesting about an approach which is based on quality is that it is very dynamic in the sense that those overweights will change over time. So you may have a year where you're overweight materials, and then the next year you're going to be overweight IT, very much depending on where the high quality companies are.
Yeah, and sticking with the dividend yield is probably a kind of a big thing to talk about in this strategy. There's a question here from Black Challenger. How do you include share buybacks in your dividend calculation?
So the short answer to that is we don't. We focus only on dividends. Two reasons for that. First, the research that underpins those ETF or those index, right? They are very much their date from like they started like 10, 12 years ago, and buybacks were less of a factor at the time. And so there is a lot of research around dividend. And so there is a lot of academic background around dividend investing, which there isn't around buyback investing. So that's one of the reasons why we focus on dividend only. The second reason is that buyback is something that is more used, I want to say, by growth or growthy companies, right, or tech companies and things like that. And by design, we want to make sure that the index is not leaning towards too much towards those growth companies, because growth, similar to small cap, is a very cyclical, volatile factor. and we wanted to minimize the impact of that. And so including buybacks would push us more towards these growth and tech factors that we wanted to avoid a bit.
Yeah, no, that makes sense. I think we've got time for one more question. I'm aware I've been absolutely barraging you with questions. So we'll go for one more and then call it a day. We've got one in here. The strategy outperforms on a global scale, but does it kind of replicate in other markets?
So testing strategies, or yes, testing investment process, testing strategies across geography is really at the core of what we do. We always test this type of rule-based investment process in multiple regions to make sure that they are robust. And so yes, overall, it does work quite well across different regions. We have a US equity index, so WisdomTree US Quality Dividend Growth Index, a Eurozone one, a UK one, an emerging market one, and they do show similar behavior. They're not exactly the same. There is always difference between geographies, but the overall behavior is quite similar. So yeah, we do test across different geographies.
Yeah, and I did point it out in the video that eventually managed to play. We do have the global and the US and the Eurozone ETFs that track those indices on the Invest Engine platform, so they're all on there. Okay, I'm going to call it a day. We've actually managed to get through all the questions, so we'll leave it there and give everyone an extra 3 minutes to get to the pub. So if you want to find out more about the WisdomTree ETFs available on the Invest Engine platform, then just click the WisdomTree banner at the top of our ETF range page, and you'll find all the details there. So thank you all for joining. Thank you, Pierre, for presenting, and see you next time.
Thank you very much.